class. We're on lesson number 47. By that means it's a milestone because we believe we've covered a lot of the whole of micro and now almost done with the macro part. Last class we went over a couple of important stuff, exports and imports. Why is that important? Well, you know, always you got to be thinking to yourself, why does my country export these products? Why does my country import these products? Yeah, okay, am I really thinking about that? Not really, but really speaking, you know, when you go out and you like something, let's say you like cars. I like cars a lot myself. Most of them I can't drive because they're too expensive. But point is, we have to understand why certain cars are expensive in certain countries and why certain cars are not so expensive, right? In Singapore, if you go and buy a Toyota Corolla, it actually costs about $80,000 US. A Toyota Corolla in the US is about, you know, below a $20,000 figure. So these are the sort of numbers that matter, and economics sort of explains why that happens. It is important to differentiate reality and economics because economics is very theoretical, but is based as a framework for reality, okay? So keep that in your back of the mind, but it's important to understand that we can apply this stuff to real life and you can understand a lot of things around you, why they are a certain way in terms of pricing or in supply, okay? So this stuff is important, apart from your AP test. It does give you a framework of understanding life and society. So coming back from that very, very big philosophical talk and, you know, a big bird's eye view, let's concentrate on the homework question. Homework question from last time was, tell me the generic rule of when countries export and import. And it's a pretty simple theory, okay? It was based on world price and domestic price. So if you look here, right, we said that our first principle said that if the world price was greater than the domestic price, we're in a surplus and that leads to an export. Let's break these down step by step. What was the world's price? World price is basically saying that if I have a particular product, let's take coffee, okay? Coffee is made all over the world, okay? A lot of different countries produce coffee and they're great at it. But point is that there's a fluctuation. There's an export and import. People are requiring they demand different types of coffee, right? Different amount of coffee, right? So all of this creates a world's price because there's an equilibrium of supply and demand in the world, okay? And that gives you a world price. However, I'm here in the United States and I'm trying to understand how the domestic market works. The domestic market has its own equilibrium, right? And that gives us a domestic price of coffee, okay? So there's a certain amount of supply, a certain amount of demand, right? But obviously know that a lot of people other than America produce coffee and they produce a lot more than the US does. However, the US demands a lot, right? So in our case, if you imagine, we actually import a lot of our coffee, okay? So if the world price is actually lower than the price domestically, that leads to an import because there's a shortage in demand. All these are better understood if you use a graph. I apologize in advance because the last class what we did was we built a lot on this graph a lot. So if it's not that clear for you, I'll try to break it down simply and then we'll work from there. Again, looking at this is the domestic market. However, we're applying the price of the world, okay? The world price as they say it. So if you imagine there's a simple supply and demand, right? Equilibrium gives you two things. One, the domestic price, which was at 4. This was, I believe, we were on beef production in Argentina. And then we have a domestic demand, right? We're at 4 here. So let's say 4 pounds of beef to $4 of beef. That was the domestic price and quantity. However, we gave you a scenario. We said, hey, listen, what if the world price of beef is actually not $4 like it is in Argentina domestically, but it's instead $2? If you imagine the difference, right? What this makes is it gives us a scenario of, if you look to the left, we're down in this scenario where the world price is actually less than the domestic price. So imagine I'm in Argentina and you're in Argentina and we love beef. Okay, let's assume that both of us like beef. And the price of the world we know is $2. But people in Argentina are charging us $4. What a ripoff. We understand that, right? At $2, you and I can afford a lot more beef than at $4. Presumably 100% more. Right? So if you look over here at the equilibrium and we understand if you take this 2 point right here, we look at the y-axis, we say, hey, you know what? We know the world price is at 2. Let's look at how much is being demanded. Well, the first line you hit is the supply. And that's how much the people in Argentina are willing to supply. The beef people not the beef people, that just sounds wrong. The people who make beef, right? The beef manufacturers in Argentina say $2 is way too low for our business model. We're going to close shop and I cannot afford to sell more than 2. So they say, you know what, at 2 we're done. Domestically, we're going to stop at 2 pounds or whatever, 2 units of beef. However, you and I are in Argentina thinking, no, wait a minute, if it's $2 per pound, we're going to consume a lot more. Therefore, if you look over and you cross the supply line and you go over here, you look at the demand, you go down and you all of a sudden see the difference between the quantity demanded, which is at 6, and the quantity supplied at 2. 6 minus 2, the difference, 4, is how much of a shortage there is in Argentina. Because at $2, you and I can consume 4 more units of beef. So how do we fill this shortage? We understand that the world is demanding $2. You and I can pay for this $2 price. So what we do, you and I sitting in Argentina, we start calling up people in other parts of the world that produce beef. Then we have an agreement and we say, hey, you know what? We want to trade in beef to our country. We're going to pay $2, which is the world price, and we want 4 units of it because that's a shortage. And that is why if the world price, PW, is less than the domestic price, PD, there's a shortage. And then because of the shortage, people want to demand and consume this, their imports into the country. A lot of steps going on, but hopefully if we break it down step by step, we can understand this. I will come back to this again, but let me first finish the other scenario. So if you look to my right again, we go back to the graph and we say, you know what, actually in Argentina, it's a pretty good deal to get $4 a pound because the world price is actually sitting at $6 a pound. People love beef so much, there's a short supply. For whatever reason, the price is actually higher than the domestic price. If you look over here, we gave you an example, it's $6 a pound. Right? Now, quite opposite to the scenario before, actually, if you start to put a line over here at 6 and you start going right, the first one you hit is actually the demand line. Because the reason being, when you go to the demand line, you come down, there's only 2 units that are being demanded. Because you and I, we can't afford as much. At 6, that's really high. And we can't afford as much. So for that reason, we say, hey, you know what? More than 2 units, I can't really afford. Only the rich people in Argentina get to eat beef. You and I get to stick to chicken. Okay? So, however, imagine my friend Andrew, right? Andrew is a person who makes beef in Argentina, okay? And he loves this. He loves the fact that people are charging $6 a pound. He's saying, hey, you know what? I can produce a lot more at 6 and make a healthy profit. So if you head to the right a little bit more and you get to see the supply line is sitting at 6. So the quantity supplied at this rate is 6 units, quite opposite to the scenario before, right? So now we understand that suppliers in Argentina, like my friend Andrew, will say, guess what? We're going to go ahead and we're going to export this amount of beef to the world because the world, people in other parts of the world, Brazil, Singapore, Malaysia, India, China say, or the United States, say that, no, we can pay $6. That's fine. So Argentinian beef suppliers say, hey, you know what? There's 4 units of surplus. We're going to go ahead and export it. And that's why, if you look over here, we said that the world price is greater than the domestic price. Again, if the world price is greater than the domestic price, we have a surplus. Surplus being because the quantity demanded, right? This is another step out of it, but we'll just write it down just in case. The quantity demanded is actually less than the quantity supplied at this point. Therefore, there's a surplus. And the surplus actually, in order for it to sell, because if I made a lot more beef and just sat in my factory in Argentina, it's not going to do anything. It's just going to sit and rot because I need to do something with it. And it's time sensitive, right? So if these get shipped over to another country, right? Let's say China and other countries start to demand my beef, I get to turn on an export, and that export turns into extra money. Okay? So hopefully everybody sees that. So at this point, we said quantity demand is less than quantity supplied. Quite the opposite in this scenario, right? So if you go down, when world price is less than domestic price, what tends to really happen is that your quantity demanded is greater than your quantity supplied, which is why we actually import from other countries because people are saying, well, we want more beef. We want to consume more beef. And we're going to look to other countries to consume more beef because it's cheaper out there, okay? This is a very, very simple formula for exports and imports. It's, again, a framework, and I want you all to think about it because economically speaking, a lot of countries do base it off of world price and domestic price. This might show up on a test, so just make sure you pay attention. Okay. Later on, to my left, we talked about this definition of balance of payments, right? We said balance of payments is defined as the following. Summary of a country's financial transactions with other foreign countries. We compared that to a bank account. We said, okay, you and I walk into the bank. We say, hey, we have two different bank accounts. We want to know what is going on. Bank manager comes up to you and he says, here, sir, here's a list of all the transactions you've made. You've withdrawn so much money on the 27th. You have deposited so much money on the 25th. And so on and so forth. And he gives you the entire history that you've been there for, let's say, 5 to 10 years. Fantastic. This is exactly what countries do too. They try to monitor how much outflow and inflow is going out and in and out of the country. Now, this is the new stuff. That was a homework question, but let's get into the new stuff. The new stuff is, how do you break down balance of payments? And let me erase this, and so we can talk about current account and capital account. We talk a little bit more about capital and current account, but I want to talk about it on the board. So we're kind of defining these terms, and we sort of understand what buckets things go under, right? We know how we can place different accounts. Now, I'll go ahead and give you guys examples, and hopefully there'll be some exciting examples on the way. But one of the tests, I can't remember last year, I'm pretty sure I saw a current account, capital account question. So just make sure you understand what's going on there. Again, one of my favorite suggestions is practice, practice, practice. If you fail to prepare, you're basically preparing to fail. I did not say that good quote. It was Coach John Wooden. But point is that make sure you prepare for these tests, because the more amount of questions you see, the better it is. That being said, first things first, let's try to understand what's going on here. Okay, so balance of payments. Okay, is broken down in two accounts. And as you guys go along in life, go to college, and I want you all to be economists, so you'll learn about another account. But for now, we know two accounts. We know current account and capital account. This is current account, and this is capital account. By far, the biggest account that accounts for the balance of payments is actually current account. Why is that, you ask? Current account actually breaks down the current export and import. So this includes exports and imports of goods and services. Okay, of goods and services. Point is, this happens to be the biggest chunk, right? We talked about different things. We talked about lower opportunity costs leading up to specialization, specialization leading up to trade, trade leading up to beneficial economies. So regardless to say, most of the world today trades a lot, okay? They have some items going out, they have items going in. In your country, I'm willing to bet there are a lot of products being imported. In my country, there are a lot of products being imported and exported. Right? This is a daily transaction. So exports and imports of goods and services actually make the biggest chunk of balance in payments. So the current account, by default, is one of the biggest parts of the balance of payments. What else does current account have apart from the exports and imports of goods and services? Let's talk about the investment income to and fro. Okay, so current account also includes investment income. Investment income. Okay, so let's start off with the first example. So exports and imports of goods and services. What does this exactly mean? Let's say, for example, that you are really into Swiss chocolate, I love chocolate, and now I'm making you like chocolate. But let's say that the Swiss are known for their chocolate, right? And you crave Swiss chocolate. So, and you don't want any Swiss chocolate, but you actually want Swiss chocolate imported from Switzerland, right? And so what you do is you go ahead on the internet, and the lovely internet, you Google Swiss chocolate, go on to Swiss chocolate, click it, and you say buy. Okay? Get your credit card out. Money flows out of your bank account from the US or wherever you are in the world, and it goes into Switzerland. And the guy in Switzerland who's making this chocolate looks at his money, he says, hey, great, you have delivered the money, I'm going to ship you the chocolate, takes his chocolate and ships it directly to you. Two things have happened there. One is that your money has gone in to Switzerland, okay? And then the other part is that his chocolate from Switzerland went to you. So your country imported a product, okay, but didn't actually export a product, but they actually exported, your country actually lost some money, went from your bank account to his account in Switzerland. So there's two effects that always happen in a balance of payment. That's why it's called a balance of payment, okay? One thing to note before I start jumping into the capital account and examples of investment income, I want you guys to understand a very, very key equation, okay? Current account, okay? Current account plus capital account must equal 0. Okay? Must equal 0. Now, there are temporary changes where it's not equal to 0, okay? And things happen. But for the most part, if there's a transaction, they tend to even out. And I'll tell you why. In our example, we said that you went ahead and you like Swiss chocolate. You got to the internet and you went online, bought Swiss chocolate. Delicious. And you got chocolate in return and gave money to Switzerland, right? Some person in Switzerland got that money. So there's two things that happened. Your country imported a product. So what is the other part of the equation? The other part of the equation actually goes in the capital account. Capital account accounts for any financial transactions going in and out. Right? So this money that went from your bank account to Swiss account is actually under the capital account. So if you look at it from the U.S. perspective, guys, one of the key things I want to understand is that when you have questions about the balance of payments, always make sure what country's perspective you're coming from, right? Because understand this, if we've given you an example, we said that, hey, you know what, you bought Swiss chocolate from Switzerland, and let's say you live in the United States, okay? Now, the thing is that United States has gotten the product, but has lost money, okay? Because it's gone from a US bank account to a Swiss bank account. If you look at it from a Swiss side, the Swiss side they have lost a product, but they've gained money. So let's start off with the US perspective, okay? In this example, if we have to look at it, we have the current account, okay? What happens in this example is that, let's look at example 1. And example 1 will be from the US perspective. Okay? So this person has went ahead and he's bought Swiss chocolate, right? So in the current account, it accounts for exports and imports of goods and services. In this case, we've had an import of a product because Swiss chocolate has come into the US. Again, we're looking from the US perspective. So in a current account, in my eyes, it's a plus because we've actually gotten a product. Does that make sense? We did not have that Swiss chocolate before, and now we do in the US. So for us, it's a plus. However, if you look at it from a financial perspective, money has flown in from the US to Switzerland. So it's gone out of the US. So in my mind, it's a minus. If we assume that this chocolate is worth about $20, okay? So again, on capital account, it's a minus because money has flown out from the US to Switzerland. And it's a plus on current account because the product has come in from Switzerland to the US. So if this product is worth $20, the US has gotten $20 worth of product and lost, hypothetically, $20 of value in money because the bank account has paid $20 from the US to Switzerland. Okay? So net effect, if you look at it, right, if you take positive 20 and add it to negative 20, you should get 0, right? And this is how balance of payments even out. I told you guys, current account plus capital account should equal 0. Now let's look at it from example number 2. Let's look at it from the Swiss perspective, right? Example 2 looks at it from the Swiss perspective, and I'll just write for SW Swiss perspective. If you look at the current account, it says exports and imports of goods and services, right, that are accounted for in the current account, part of the balance of payments. Switzerland has lost a product because some guy in Switzerland has received money, that's fantastic, but he has to give the product to the guy in the US. So he ships this product. So the product of Swiss chocolate leaves from Switzerland and goes into the United States. Okay? So from a current accounts perspective, we're talking about an export of a good, right? So it's actually a minus because they've lost, right, a product worth about $20. However, on the flip side, the exact opposite, if you look at the capital account, which accounts for financial transactions, we notice that the person in Switzerland, yeah, he's given the chocolate, but it's not free. There's no such thing as a free meal, right? Econ 101. So what has happened is this guy has gotten money into his bank account, presumably for $20 because the product value is $20. And then again, if you take minus 20 plus 20, right, you get 0. Understand why this is so different. Depending on what country's view you come from, okay, your answer is going to be different. The sign of the product is going to be different if you look at each account. The result is the same. It's going to be 0. It's going to even out. But the point is that where they try to catch you, okay, is that when they ask you questions about capital and current account, they're trying to see if you can understand this country perspective, okay? So if they say, give me the perspective of the Swiss, you have a different answer for current account and a different answer for capital account. If they say, you give me the perspective from the Americans, you have a different answer for capital and current accounts. Very important to note. Okay. What are some more examples of current account and capital account? Let's go off. We gave you guys an example of current account, but let's talk about capital account. Let's say that, you know, I'm sure all of you know Bill Gates. Bill Gates is a very rich man, and he happens to own a company called Microsoft. Doesn't technically own it, has a majority share, or has a significant share rather, in a company called Microsoft. So Bill Gates has a lot of money, okay? So he's trying to invest his money because he has a lot of it, and he doesn't want to keep it in one particular thing, Microsoft shares. So he says, you know what, I want to go ahead and invest in other opportunities. So he travels around the world, and he checks out Dubai, okay? The Dubai economy recently crashed, so keep that in mind, but say he sees a good opportunity, and he sees a great real estate opportunity, and they say, sir, if you want to invest in Dubai, you need about $100 million. So if Bill Gates puts in $100 million into Dubai, okay, and he buys out this firm, real estate firm in Dubai, that comes under the capital account. Basically, any financial transactions come under the capital account. Okay? Simple, straightforward, hopefully clear. The other part of it is investment income. How does investment income happen? Well, let's say the US invests in bonds across the world and foreign currencies across the world. If they make interest or have to pay interest, that comes under the current account. Small part of current account. Big part is exports and imports of goods and services. So keep your eye out for these, but also keep in mind the investment income does come under current account. Capital account accounts for any financial transaction. So that is the more simpler one. Okay. So now let's talk about how the government takes care of balance of payments. Let's talk about surplus and deficit. Okay. So we know, let me just go back to the definition of balance of payments. Balance of payments is a financial summary of countries' financial transactions with other foreign countries. So what is a balance of payment surplus and what is a balance of payment deficit? So let's erase this. any ideas should start off with the previous knowledge that we've had before. And the previous knowledge of what we know about surplus comes from a fiscal perspective, right? When we talk about fiscal policy, we said when a government has a surplus, their revenue they make from taxes is going to be greater than the amount they spend, right? Different? Yes, very much so. Balance of payments. I just want to refresh you guys, not to confuse you. But balance of payments has two scenarios. It has, let me go ahead and erase this completely. But it's two scenarios, surplus and deficit. So how does a surplus come and how does the deficit? They're still pretty logical in your head. They should be, but we'll define it anyways just to make sure everyone's clear. Okay. So balance of payments and this time we'll talk about a surplus. When is it a surplus? It's a surplus if there's more inflow of money, right? Because you're looking at transactions all from a value perspective, okay? Than outflow. Okay. And then a deficit would be more outflow than inflow. Great, pretty straightforward. I mean, sort of a dull moment, but you know, we still need to understand it because we need to be clear. So let's talk about a surplus. Let's say that the U.S. government, right? When does it receive funds? Let's say the U.S. government is exporting money, okay, or exporting goods. If they're exporting goods, let's say they export to a country. Let's choose Canada. Okay, they export to Canada. Canada gets the product, the American product, and in return they give you money, right? So our current account is getting an inflow of money when we export products. I hope that makes sense. We being the United States. So if that equation that has a positive, temporary positive moment, we have a balance of payments surplus. How do we take care of a surplus? Because a surplus or a deficit are not good. And a government tries to correct that, okay? They try to correct it. The way they correct it is using this term called official reserves. Okay? Official reserves. Okay? Official reserves basically is the quantity of money, Q of money, held by the feds. In the US case, these are the monetary authority, okay? So this is the money that the country has. The United States in this case is held by the feds, right? And they say, hey, you know what? We have a surplus of money coming into the US. What we're gonna do is we don't want a surplus or a deficit. So we're gonna use this money, this inflow of money, and we're gonna transfer it to the official reserves, right? Now, why would they do that? Why would they want to make sure it's correct? The balance of payments is a very intricate balance because what it does, it affects a lot of other things. And we could talk about this in the future as well, but it talks about circular flow of money, right? Currency is very, as you guys know, probably fluctuates a lot. If you read the newspaper, every day your money, wherever you're in the world, fluctuates on a daily basis. So all of this affects currency, affects interest rates, affects a lot of different financial metrics. Point is, our balance of payments should be even. We should hit that zero number. And if you have a surplus, they take the money out and put it into the official reserves. What happens in a deficit? In a deficit, what they do is that they take this money from the official reserves and pump it back in so that we're, again, back to zero. So the official reserves are a tool to battle deficits and surplus for balance of payments. Okay? So let's review real quick what we've gone over. In this class, we went over current account and capital account, gave you guys examples of both. Be careful of the perspective. We talked about official reserves, surplus, and deficit, and how we use official reserves to battle that. So here's your homework question. Tell me the difference between capital and current accounts. Should be pretty straightforward. I'll see you guys in the next class. Thank you.